Hello, everybody, and welcome to the Like a Tortoise channel. Happy Friday. Today is January the 16th. In what a week it's been. I can't believe how fast this month is flowing by. But I think that's good news, right? It means we are having fun. Guys, today's video is on Fieldhound's three valuation methods and how I use them, how I incorporate each of them into my company analysis. So hopefully you will be able to drive a lot of value from to derive a lot of value from today's video. So make sure you stick around for the next few minutes because I will try to break down each and every single one of these methods. Okay, but before I do so, I want to say again, big shout out to Ether if she is watching this video today. We had a great session on technical analysis that she delivered for our community of like-minded people. And some of you may be asking, "Oh my God, Ed, but I mean, technical analysis, you are fundamental-driven investor." Yes, but that's why I mentioned this as I share this on my LinkedIn page. A big thank you to Ether for delivering a fantastic webinar to our community in walking us through the ins and outs of technical analysis, while our investment philosophy remains firmly rooted in long-term fundamentals, fundamental-driven investing. Technical analysis plays an important complementary role in our process, helping with timing, risk management, and entry points. So Ether did indeed a great job breaking down complex concepts in a clear and practical way, giving our members tools that they can apply alongside their fundamental research. Sure enough, we already have a full module on technical analysis on our Skool community as well, but Ether doing this on a daily basis, she's definitely in a better position to break that down to them, and she created a lot of value. So thank you, Ether, once again, and thank you for our viewers. And I know some of you actually joined both our Skool community and our WhatsApp group after following us on YouTube. So I mean, congratulations. Some of you are actually quite young, and I'm so happy. I wish I started watching videos like these when I was younger, because that certainly would have stopped me from making silly investment decisions and lose some money along the way. But anyway, you learn from your mistakes, right? So fantastic. If you didn't manage to join, don't forget that we also have another free event on January the 22nd. Already 150 people have signed up, and this will be about the core of our strategy as well, which we discuss here on this channel at length, why most investors underperform and how to fix that. So stop sabotaging your results, right? That's what we want. And so make sure you join if you can, because it will be jam-packed with value, okay, which is what we want, and it's entirely free as well. Okay, let's delve deeper into today's lesson, Fieldhound's valuation methods. And I know that you guys loved the Google sheet that I shared online. So I think I'm very thankful that you have been showing some support, and I'm glad that you are finding it value. Just want to make sure. I just want to make sure that this sheet that I'm about to show you, I won't be making available, because I mean, I have to share value with my clients, of course. In this sheet, is the sheet that I only share with them. Okay, so but you can easily build the methods that I will be discussing with you on your own, because I will walk you through each and every single one of these cells. Okay, so you will learn exactly what they mean. But what I also have is my intrinsic value calculation full model template, which again I only make available to clients. But I wanna introduce this to you so it makes sense, okay? Because otherwise you just see a ton of numbers, you don't understand anything. So you can see that on the left hand side I have some of the most important numbers on the financial statements, right? So look, balance sheet items, income statement items, cash flow statement items. And then on the right hand side, I have some of the most important metrics that I'm tracking, namely valuation ratios, profitability and value creation metrics, margins, as you can see, capital intensity, solvency metrics, and valuation process. Okay, and then I highlight the cells in red, green, or yellow based on what I think those are good or bad numbers. So, for example, in the case of the price, if the price to earnings is, for example, above 15 times, it's not as green as it would if it were below 15 times. Does that make sense? So this is how I build it, because I'm a visual person and I want to make sense of the data quickly, right? That's how it works. Awesome. So now, if I scroll down, this is where I have this is what I have Phil Town's three valuation methods that I also use. And so what throughout this video, I will show you how to use each and every single one of them, and hopefully you will gain a ton of value. Okay, I will use three companies as an example, both, and the three of them belong. The three of them can be found in different industries as well. And so what I want to say is that the first thing that I typically do is I want to collect the numbers on a 10-year, 5-year, and 3-year basis. And because I like to understand how the growth rates have evolved over time. So, for example, I'm doing Novo Nordisk. This will be the first example that I will be covering today. It's not in my portfolio, full transparency, but the reason I'm doing it is because one of our clients, Lucy, bought this company, and way to go, Lucy. She's been killing it because she literally caught the bottom. I'm not sure, unless the company rolls over, which can always happen. I'm not in the business of timing the markets. I'm in the business of buying high quality companies trading at a significant discount to their value. And so you have the best of quality with the best of valuation, and that creates a great recipe for success. Okay, and I do think Novo fits the bill, even though I didn't put money into it because I just find healthcare boring. However, they operate in a duopoly. They have a strong competitive advantage, and she understands it better than I do. And so she did her analysis, and after we both did the valuation, we decided that this is the nice time to buy, as I will show you. Okay, so again, nothing that I'll be sharing here is financial advice. Always do your own due diligence, and yeah, all we share here is for educational resources. That said, I'm very transparent with what I do with my own money, as you all know. So, margin of safety. Guys, the margin of safety method is best suited for companies that are growing at faster rates. So, for example, if the company is growing, if the projected growth rate for the company's earnings is 15%, 17%, it makes sense for you to use this model. Otherwise, if the company is growing at 9, 7%, or 6% per year in some cases, what it does is it will really translate into a very low margin of safety price, okay, which is not accurate. All right. So, and that will make it unsuited. It will deem it unsuitable. Okay. So let's start with earnings per share. What are the earnings per share of Novo Nordisk? If I go here to my stock analysis tool, and by the way, you can do this for free. I don't have any affiliation with stock analysis. Okay, so I don't pay for them also. So this is all free data. You go here to the overview tab, and you can see the earnings per share is 3.67. Okay, so that is the number that you put right here. And then what you are trying to understand is what is the past growth rate of those earnings per share. And if I look here, so if I go here to earnings per share right here on the left hand side, you can see that over the last 10 years they've grown by about 15%. Over the last 5 years they've grown at about 22%. So there has been an acceleration, as you can see. But analysts are projecting growth of, here we go, look, earnings per share long-term growth estimates of around 8.6%. I will choose the most conservative of these. In this case, about 9%. So that is the number that I will put right here. Okay? And by the way, let me take a step back and explain to you that Philtown I'm not sure. I assume you guys are already familiar with them, so apologies. So I didn't explain. But Phil Town is an investment guru. Is well famous like across social media, and I attended his virtual investing webinar as well, which I found very insightful, and I learned a ton. And so to this day, I still incorporate these methods into my own framework. Okay, cool. And I like the fact that he builds a margin of safety into each of these methods, as you will see. So all these three methods have a 50% margin of safety built in. And I love that. I'm a conservative guy with my money. So, yes, of course, I love that. Okay, so we have our 9% right here. Now, the default PE is going to be twice the growth rate. If you expect earnings to grow at 9%, so you do 9 times 2, and that means 18. But look at that. The historical 10-year PE is around 24, and that's why I settled for 20. Okay, because I still think that in 10 years, Novo is going to be trading at least at 20 times earnings. And so it makes sense for me to use 20 right here. So that is the conservative number. And what we will do right now is, how do we do that? Now we have this cell, estimated future earnings per share. So what we will do is, let me zoom in, we will take the 3.67, right? And we will grow 3.67 at our projected 9% growth rate over the next 10 years to get our estimate future earnings per share. You pick an online calculator and you do that 3.67 growth in growing at 9% over 10 years. That gives you what? $8.69 dollars per share. And boom, that's the number that you have right here. Okay. And now to calculate the future price per share, you simply multiply 8.69, which is the future earnings per share, by your default PE of 20, and you get 173. What does that mean? It means that if the company does go on to grow earnings per share at 9% per year over the next 10 years, then in 10 years, the price per share will be around 173. Okay, now this is the future. Uh, um, this is the future value per share. But remember, we now have to discount it back to the present, because what is the intrinsic value of a company, everyone? Is the intrinsic value is based on, so it's based on the projected free cash flows, right? So it's based on the future cash flows discounted back to the present value. And we use a discount rate, which in our case is 15%, because we always want to double our money every 4 to 5 years. And so a very easy way to do that, you do 173 divided by 4, because if you compound money at 50%, you have 2 doubles in 10 years, right? Right? So at 15%, your money doubles every 4.8 years. So you have about 2 doubles in 10 years. If you divide this by 4, that gives you the intrinsic value per share of 43. And what is the current price today? 60. Okay. But you never pay the intrinsic value. So you want to buy with a 50% margin of safety, which is going to be 21. 53.45 divided by 2, that equals 50. That equals 2021. You see what I mean? That's why the margin of safety method is best suited for companies that are growing fast. Otherwise, it will give you a very low valuation number, and it's not accurate. Okay, so if in these cases, yeah, you will use the payback time and the 10 cap rate. Okay, for a company like Netflix, for example, or Amazon or Google or any other company growing by, I don't know, anything above like 12%, you will use the margin of safety calculation, especially if they are going anything anywhere between 13 and 15% or beyond. I like using the margin of safety. So using the payback time, what is the payback time, everyone? And why is it so important? The payback time forces us to think as business owners, which we all are. If you guys are following this channel, then you know that I always emphasize the importance of thinking as business owners. Never buy a company if you didn't want to own it outright. And so, if we buy, what the payback time tells us is, if I could buy the company today, if I could buy the whole company today, how long will it take me to get my money out of the business from free cash flows? Okay? And we want that to be in about 8 years or less. Okay? Why 8 years? Because the average payback time for an S&P 500 company is about 16 times. If you look at the average PE for the S&P over the last 10 years, or excuse me, over the last 70 years, I mean, it's about 16 times, 17 times that we want to buy it with a 50% margin of safety. And that's why we use 8 years instead of 16 or 17. Does that make sense? Fantastic. So very simple to understand. We only need the free cash flows, and we already have them right here. Another thing that I want to say, look at this. So the price is in dollars because my client bought the ADR shares, but notice how the financials are in DKK, Danish. So you make sure you make the conversions, right? And so if I go to the trailing 12 months and if I convert this number 65,972 to dollars, I get the number that you see right here, about $12 billion in free cash flow. And this is the number that I will grow at my projected 9% growth over the next 8 years. Okay, this is what you see. And then what you do is you sum up all these free cash flows, and that gives you 123 billion. And if you divide that by the number of outstanding shares, boom, you have the free cash flow per share in year 8 of about $42 per share. What does that mean? It means that if you got the chance to buy Novo Nordisk at $42, and if the company is capable of growing its free cash flows by 9% over the next 8 years, then you will be able to recoup all of your investment. Assuming you would buy the company outright, you would be able to recoup all of your investment in 8 years. And the price that my client paid for the company was actually $43 per share. Okay, so if I go here to our stock, to our eToro, she literally caught the bottom, and this is and so look, not to say this can't roll over, but because remember, over the short to medium term, the market is a voting machine. Over the long term, it's a weighing machine. We are long-term investors. We believe that we were buying a great business at a very discounted price. Okay, and that's what she did. Awesome. So let's go back here to our example. And then what you can do is, instead of free cash flows, you can use earnings. I typically like to use both, but both earnings and free cash flows should converge over time. But if the company is doing a lot of capex, free cash flows will be significantly compressed. And so it may not be, in fact, it won't be realistic to use free cash flows in that case, would it? And that's why you could use earnings here. All right. But this is what we do. This is what we have. Now, let's do the 10 cap rate. So I will explain to you the margin of safety. I explained to you the payback time. So what the heck is the 10 cap rate? Let me explain that to you. The 10 cap rate was adopted from real estate. Why? I have it right here. I broke it down. I actually made comments against each of these cells so I can walk my clients through each of these numbers. Let me show you right here. Total owner earnings. Let me see. Okay, right here, everyone. In real estate, bear with me, this is important. Let me zoom in, okay? This will allow you to understand this method and why we use it. In real estate, investors often accept a 5% cap rate. If you are in real estate, you know that. Meaning the property yields 5% of its purchase price each year before growth. Fieldtown uses a 10% cap rate instead because he wants a built-in margin of safety. So a 10% cap rate means the business generates a 10% pre-tax yield. A 10% pre-tax yield, right? In other words, you are earning 10% on your money and would recoup your entire investment in about 10 years, even if the business never grows. And that's exactly what the logic behind this method is all about. Okay? So, how do we do that? The way we do it is we want 10%. So we want to do this. So we start with operating cash flows, okay, and then to the operating cash flows we will add. So we have the total capex, and we want to subtract the maintenance capex. Why is that? Because remember, let me break down total capex to you. The total capex, so capital expenditures, is the money that the business is using to invest in plants, property, and equipment. Now, the way it's built is you have maintenance capex, which is the money that the business uses just to maintain its current operations, and you have growth capex, which is the money that the business uses to grow the business, to invest in things that will translate into higher profits down the line. We want to keep that growth parts, but we want to subtract the maintenance parts. And if you don't find it on the annual reports, you can assume that it's typically around 15 to 70% of total capex. Okay, and so 70% of about 8 billion, that is about $6,285,000,000. Okay, this is already converted. And how do I get the operating cash flows? Again, you go to here, right? So you go to the cash flow statement, and you can see that you can get the operating cash flow right here, and this is the number that you have to convert to US dollars. Okay, and capex, you have it right here. Look, capital expenditures, you convert this one to dollars as well, and you will have both these metrics. Okay, and now we want to add the tax provision. Why do we want to add the tax provision? Because remember, we want pre-tax owner earnings. Okay, and so how do you calculate operating cash flows? You start with net income, but the problem here is that net income already accounts for the taxes and interest payments on the debt, and we want to add back the tax portion. And so I explained that here very well as well. Look at that. Where is that? Oh, it's right here. Sorry. It's right here. Bear with me. Oh my God. Look, operating cash flow is calculated after tax because it starts with net income, which is already reduced by taxes. However, Fieldtown's 10 cap method values a business on a pre-tax cash yield similar to a real estate cap rate. Okay? And that's why he adds back the tax provision. This gives a clear estimate of how much cash the business actually generates before the government takes its share. And by the way, Warren Buffett does that as well. Okay, so for example, one of the things that Warren Buffett does, and you can find this in the book Warren Buffett and the Interpretation of Financial Statements, you can see that the metric that he uses to analyze businesses is typically EBIT, or earnings before interest and tax. Okay, earnings before tax. Okay, which is right here. I'm not sure if they have it right here, but yeah, it's earnings before tax. And so Warren Buffett himself uses that right here. Right here. Look, pre-tax income. This is the metric that he uses. Okay, it's the same thing that we are doing right here. And so what he does is he does net income, but he adds the income taxes as well. Okay, Cool. But of course, with the operating cash flows, we add all non-cash expenses like depreciation, amortization, changes in working capital, and so on and forth. The real owner earnings of the company. So let's go back here. All right. So that's it, guys. So now what we do is operating cash flow minus maintenance capex plus the tax provision gives us the total owner earnings. And now what we want to do, we divide the total earnings by the number of outstanding shares, and we get the total earnings per share of $3.88 per share. And if we multiply this by 10, we get $38 per share. What does that mean? It means that if we buy the company, and by the way, what you will see right off the bat is that unlike the payback time and the margin of safety method, the 10 cap rate is the most conservative because it doesn't have any growth assumptions built into the model. Okay? Notice that we don't have our 9% growth assumptions built in. Okay? So if we pay $38 per share for Novo, and if the company doesn't grow its earnings, so if they stay constant, it will take us 10 years to get our money back in owner earnings. That's what the interpretation of this method is. Okay? And now look at that. Both the payback time price and the 10 cap rate price are quite similar, right? And this is precisely what I like to see. I like to see at least two of these methods converging, right? Two of these methods should be similar, and this means that your reasoning is correct, your math is correct, and so yeah, it's exactly what we want. Now, look, remember, does that mean the intrinsic value of Novo is about $38 per share? No, because they have a 50% margin of safety built in. So this is the margin of safety price you should pay for the company. The margin of safety, the intrinsic value is double that. So for example, 38 multiplied by 2, this means that 76 is the real value or the intrinsic value per share. So if you bought the company at 42, right, or if you bought the company at 38, you had a 50% margin of safety. So you can choose whichever of these you want. You can choose whether you want to buy it at 38 or at 42. We chose 42. Yeah, and we were right because the company never came back down to 38. If it's a well-established company, a business that you understand that has a moat, okay, you can be, I mean, come on, guys, between 42 and 38, you don't have that big a difference, okay? You already have, they are quite in line, and so you can buy it at 42, okay? And that's exactly what we did. Okay, I took longer because I just walked you through the entire process, but now we will do this for two other examples, okay? Novo does not currently, it doesn't, is not part of our portfolio. So for the next two examples, I will use PayPal and I will use Lululemon. Okay, both of which can currently be found in our portfolio. Awesome. So let's start with whichever comes first. Okay, PayPal. Let's change everything here. PayPal. Let's change it here. PayPal, or as many of you are calling it, PayPal. Okay, awesome. So, overview, let's have a look. So, this is in dollars, and the financials are in USD as well. Okay, good. So, we start with earnings per share, remember, for the margin of safety, and we have about 4.98. That's what we have right here, 4.98. And then we compare the past growth rates, and you can see that earnings per share have grown by 17% over the last 10 years, 22% over the last 5 years. So, okay, so we have about 17%. And you can see if you go to the stock, if you go to FinChat, you can see that analysts are projecting, look at that, earnings per share long-term growth estimates of around 12.2%, so call it 13%, and that's the number that I used right here. Okay, conservative number. Well, I used. So 13%. So growth rate is about 17, right? As we discussed right here over the last 10 years. Analysts are projecting about 13%. I use the most conservative of them. And then the default P is twice the growth rate. So twice the growth rate would mean 26. Yeah. Look at the historical PE though, 41. Look how much the multiple has compressed. The market is so negative on this company. And over the last many years, there, I mean, rightly so, because past management, in my opinion, was not executing well, and that translated into the business slowing down. But so, okay, so we have 2641, choose the most conservative one, 26. And now, if we grow 4.98 at our projected 13% growth rate over 10 years, we get an estimated future earnings per share of what? 16.90, right? So look what I do. 4.98 at 13% for 10 years, that gives you 16.90, which is the number that we have right here. And then you multiply this by the P, by the assumed P in 10 years of 26, and you get an intrinsic value of 109. Okay? And what do we know? We know that we don't want to buy it at the intrinsic value price. We want a 50% margin of safety. If you divide that by 2, you get 54.9. And what is the current price of today? What's the current price today? 56. So you can see that using the margin of safety, we have our margin of safety at about today's prices. Okay? And look, I use the higher growth rate, so it makes sense to use this method here as well. Okay? Moving on to the payback time, which tells us how long it will take us to get the money out of the business from free cash flows. Okay? I like to do both, so I like to do it free cash flows and net earnings, but free cash flows is the most important metric, as I already explained. So this is the last 12 months free cash flows, which you can get by going to financials, cash flow statement, trailing 12 months, and you can get it from here, as you can see. Now, I know management is projecting free cash flows of about between 6 billion and 7 billion at the end of quarter four. I could use those numbers. Okay, I could definitely use those numbers, but I will stick with what we currently have. I will stick with the trailing 12-month figure. Okay, and so if I do that, so let's grow these free cash flows at about 13 at our projected 13% over 8 years, and then if you sum up all these cash flows, you get about 80 billion. And if you divide 80 billion by the number of outstanding shares, you get a free cash flow per share of $83 per share. What is the current price? $56 per share. So look at that. I mean, look at that. Because this method, as you know, already has a 50% margin of safety. So look at that. And we can buy PayPal today at 50. You literally can't give this thing away. All right. And now let's use our 10 cap rate. So what does that mean again? What's the interpretation? It means that if you buy, and by the way, look at that. So I'm going to do something that I haven't done on the channel before. So the current price is 56, which means we will be able to recoup our investment under 8 years. Let's sum up all the cash flows until here 5 and see what we have. And if we do that, we have about 40 billion. And if we divide 40 billion by our number of outstanding shares, we will have $42 per share. So it's definitely not in year. It should probably be in year 7. It should be in year 7. Let's use that. Look at that. Let's try this. Let's sum up everything. Okay, that gives us 65. And then if I do 65 divided by the number of outstanding shares, look at that. you get about $68 per share, yeah, which is even lower than the current price right here. So if it's not six, if it's not on the seventh year and not on the fifth year, it's definitely on the sixth year. Which means, guys, if we buy, it means that if we buy PayPal at today's share price, it will take us about 6 years to recoup. It will take us about 5 years to recoup our investment from free cash flows. If the company can grow those free cash flows at about 13% per year. Okay, so this is the interpretation. And you want it to be under 8 years, preferably, either eight or less, or fewer years. Excuse me, either 8 or sooner. Awesome. So let's do the 10 cap rate. We start with operating cash flows. We do the total capex. We subtract the maintenance capex, which is, if you don't find it on the income statement, it's typically about 50 to 70%. 70% of that total capex is 603. And then we add the tax provision, which again you can find on the income statement right here. Where is this? Where is this income tax expense? Right here. Okay, look at that right here. You get to the total earnings, and then if you divide the total earnings by the number of outstanding shares, you get $7.22 per share in owner earnings. And if you multiply that by 10, you get 72. Okay, so it means that buying PayPal at 72 means that even if owner earnings don't grow over the next 10 years, so even if they stay flat, you will be able to recoup your investment in about 10 years because you have a 10% pre-tax yield on your investment. Okay, that's what it means. And so what's the real value of PayPal? Which of these methods are you going to use? Okay, you can choose. Look at that. Look how payback time, again, is very similar to the 10 cap rate. So you can choose whichever you want. Typically, you could go with the most conservative, which is the margin of safety price. I'm okay with paying, for example, 72. And that's what I did. In fact, lower, because my cost basis on PayPal is around 66. So it was actually lower. But this is what I'm comfortable paying. And that means that it means that PayPal's intrinsic value, according to the 10 cap rate, is 72 times 2, which is 144. With the stock price currently at 56, you have a substantial margin of safety, in my opinion. Okay, awesome. 2 examples already nailed down. Hold on a second. Oh my God. I hope you guys are enjoying. Smash the like button if that is the case. I'm pretty sure I will be hoarse tomorrow, but it's well worth it. I like this stuff, and you guys have been very supportive as well. So I'm very glad that we are doing this together. Okay, so let me just walk you through one more example, and that is in another industry, and that is Lululemon. Okay, and let's do that. Lululemon. Where is Lululemon? This is my watch list, by the way. Lululemon. Okay. Same story. Look at the past growth rates right here. Okay. This here, I don't think this is correct. Yeah, this is definitely not correct. So, but you look at the 10-year figures and the 5-year figures. Okay. So it's about 28%. And let's start with current earnings per share. So we would go here, Lululemon, get everything ready. Okay. And let's take earnings per share, which, by the way, what are the financials? Is everything in USD? It is indeed. So let's use that. So we have 14.48, which is what you have here already. Of course, I update this consistently, which is why you already see many of the numbers already updated, right? And then you can see that earnings per share growth rate has been about 23%, like 23% over the last 10 years. But if I go to FinChat, analysts are projecting future growth of around 8%. So that is, I will be using 9%, okay, because it's more conservative compared to 23. And so you will default the PE. So the default PE is twice the growth rate, which is 18. But the historical PE is about 42. And I think in 10 years, chances are Lululemon will be trading at least at a PE of 20. And so I use PE right here, which is already conservative historically, okay? And not far from my projected growth rates of 9%. Excuse me, not far from my double PE of 18 times, okay? So now if we grow 14.48 by 9% per year over 10 years, we get our estimated future earnings per share of 34.28. And if you multiply that by our PE of 20, you get the future earnings per share. So it means you will get the future. Yeah, so it means you get a future earning. It means you get the future stock price of $685 per share. But this is the future. Now we have to discount that back to the present, right? Because that's what the intrinsic value is all about. We discount the future cash flows back to the present at an appropriate discount rate. So you divide that by 4, and you get the intrinsic value of 171. And sure enough, the margin of safety price is 85, which is well below current levels. Why? Because the growth rate is quite low, quite small. So this method, again, is not suitable for a company that is growing for growth assumptions below 13%, in my opinion. Anything certainly below 10%. Okay, it will be unrealistic if you ask me. Okay, so let's use the payback time and the 10 cap rate. Payback time, look at the free cash flows. One thing that I want to point out is typically, as you know, over the long term, the free cash flows and net income should converge, right? They should be similar. Right now, look what's happening in the case of Lululemon. So current free cash flows are at about 1,121 million, and earnings are much higher. But you have to understand why that is. The reason is because of capex. So if I go here to Lululemon financials and cash flows, you can see that the company has been ramping up capex. So it's using a lot of those free cash flows to reinvest back into the business to stay competitive, right? And that creates the illusion of a lower cash flow. But over time, you assume those investments to convert into profits, okay? So take that into account because it's important. And for that reason, you can either add the growth capex portion to the free cash flow, okay, which is more reflective of the company's real free cash flows, or you can use the net income, and that's what I did. Okay, so if I use net income instead of free cash flow per share, you can see that you grow net income by 9% per year over 8 years, and then you will sum up all these earnings over the next 8 years. And if you divide that by the number of outstanding shares, you will get $174 per share. Even if you don't do that, guys, even if you stick with your even if you stick with current free cash flows instead of using the adjusted free cash flow per share that I'm suggesting, you have about $113 per share. And if you do 113 multiplied by 2, that gives you an intrinsic value of 226, which still is above the company's current price levels of 215. But you don't have a margin of safety if you stick with this one right here. Okay, now because I understand the business again, I'm very comfortable sticking with the earnings I'm very comfortable using net income instead of free cash flows in the case of Lululemon because of that. Okay, and because of what I'm about to show you. Because if we run the 10 cap rate for the company, look at that. You also have owner earnings of about 174, which is practically the same, right, as the earnings per share. It makes sense because the operating cash flow uses you start with net income, so it makes sense that they are aligned. And this is the one, this is the metric that I would use in the case of Lululemon. Okay, and so we start with operating cash flows. We subtract maintenance capex from the total capex, and then we add the tax provision, and then we get to the total owner earnings, right? So which the total owner earnings is the operating cash flows minus the maintenance capex plus the tax provision, and then you divide that by the number of outstanding shares. You get the owner earnings per share, and if you multiply that by 10, you get 174. Okay, so if the company does not grow, if owner earnings stay constant, then you will be able to recoup your investment in 10 years if you paid 174. Okay, awesome, guys. So now you understand why I bought both PayPal and Lululemon. And the reason is because I had a significant margin of safety. Otherwise, I wouldn't have purchased them. And so you have to understand the valuation. Valuation is the last thing you should be doing. The first thing is you have to determine if the business checks matches all your criteria for quality. And then if it checks out all the boxes, then you will determine the margin, you will determine what is the intrinsic value of the company and whether you have a margin of safety or not. Okay, so if I use the 10 cap rate for this business, 174 multiplied by 2, then you're going to have 174 multiplied by 2, you will have 348, which is the intrinsic value of the company. And that's why I'm still expecting a lot more upside from current levels. Okay, guys, that's it. Thank you so much for bearing with me. We've been on this call for about almost 50 minutes, but I really wanted to be very clear and I wanted to provide examples across different industries. And and I do hope that you've managed to gain a lot of value from it. So if that was the case, let me know in the comments below, and I will be sure to follow up with you as I always do. I always reply to your comments. And yeah, guys, I hope you managed to understand that. And of course, I will be doing that more often for other companies that I'm assessing, because I always use Phil Town's methods. Okay. So stay tuned for more, guys, and thank you so much for joining our free Skool community and free WhatsApp group. You guys have been amazing. This is what's going to continue to create a lot of value for us going forward, and hopefully more people will hear this message. Thank you, everyone.